We now put the spotlight on the mutual fund industry. Vivek caught up with a slew of top mutual funds CEOs a few days ago and started by asking them if the worst was over for the mutual fund sector.
I think you have to take a view of what's happening in the industry by asset class. And then, of course, to get the big picture, you have to look at the total business that we as an industry manage. And have you heard from my colleagues in the morning that the assets under management are at an all-time high. Having said that, to get a clearer view, you need to then look at the two main asset groups that we manage, which is equity and debt. Clearly, the news on equity is not so good. And I think it has less to do with fund industry. It's just more an investor's choice to move away from equity as an asset class, given what they see in terms of returns in the market and their perception of what is reasonable to expect in the near future. But clearly the theme that seems to be emanating very different from the last debt market growth for the industry. If some of you will recall, in 2000 to 2003, the industry really built its assets around fixed income products or debt products. But at that time, the key feature driving that growth was actually a lot of institutional money which was coming into money market funds and of course debt funds also. This time, the big change for the good is that yes, it's debt market driven or fixed income asset class driven growth, but that is largely being contributed now from retail investors, and that's very good. So it depends on what you want to see. You want to see the 35 lakh folios lost in equity, or you want to choose to look at the 8-9 lakhs addition to folios in the fixed income space. So I think I'm generally a believer that any industry like ours will always be subject to cycles in the market, and frankly we would just like to hope that the tough cycles are shorter and the good cycles are longer.
Have we seen the worst in equity redemptions according to you?
Yes, your question on redemption. I think what happens is you might still see a little bit of redemption based on time of entry of each investor. So right now the mood seems to be at every kind of point of meaningful rally. People want to see if they want to get out into a safer asset class. But I think if the market stabilize at a certain level and stay there for a while, which we expect at some stage to happen, whether it's the current level or maybe a few points lower, then we will see stability and we will see a significantly low level of redemption. For example, I think the level of redemptions in June are clearly less than what they were in the month of May. So we look like a little bit of tapering of redemption pressure as well in equity as an asset class.
Ashu?
So clearly we've seen the industry grow very well last financial year, and it's wonderful just to take a minute to celebrate that, because not all industries have grown well. I think apart from what Milind said, which is the fact that debt drove the growth, the fact that retail investors continue to look at mutual funds, albeit in fixed income funds, I think that's a great thing. Three things I'd like to point out. One, during this year, the industry has put in a lot of effort as far as investor education goes. The 2 bases that the regulator asked to be set aside has been put to good use. And I think the fact that investors look at mutual funds, I think got educated around debt funds is an outcome of this process. The second thing, I think almost every single player has looked at getting in some efficiencies at the back end. If you look at the deployment of technology, if you look at the fact that the consolidated account statement happened, or the fact that today everybody receives SMSs regarding their purchases, redemptions, their SIPs, I think that's a move in the right direction. And the most important thing, the most heartening thing, is the fact that the journey towards broad basing of the industry has started. It's the first time we've seen that the flows from beyond the top 15 cities have gone up from the previous year. It may be a small number, but big things start with small steps. And there you will see that there is good balance between money coming in equities and in fixed income. And from our point of view, it really doesn't matter, as long as they make the choice of coming into mutual funds, there is an opportunity to engage with them, to then look at upselling and cross-selling. And I think at this time where investors are very nervous around markets, I mean, you know, this kind of volatility hasn't been seen in the past. It's all right even to start with a money market fund, because there itself you will see wealth creation. It's not just in equities, but the key thing is for that engagement, so that even over sustained periods of time, we can work with the advisors, distributors to really move customers into other products. And finally, I think as an industry, performance has been good, whatever measure you take.
Right, you can catch more of that panel discussion coming up at 12 o'clock on Bloomberg TV India. But coming up next, ONGC